Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for January 11th, 2020. Please share a disclaimer for important information. Welcome to the first Market Minutes of the new year, 2021. This is Eric Boyce. Good to have you with us as we try to put 2020 in the rearview mirror. Last week, we did not have a Market Minutes because we distributed our 2021 outlook. If you have not received that, certainly welcome an email from you. Be glad to send it to you. Please shoot me a note at eric@bkawealth.com. I'd be glad to send it to you. But as we start off the new year, there's actually a lot to talk about. Most recently, we've had the Georgia Senate runoff elections. Aside from the kind of the untoward news flow with the riots and things like that, which is less desirable, we've had a positive backdrop overall to the equity markets. We'll talk about the investment markets primarily today. We spent a lot of time in the outlook piece last week talking about some of the economic variables, so I'm not sure that I'm going to jump into that too much, but obviously everyone's quite interested to know how folks are reading the tea leaves as we're in 2021. But I'd say on balance, as we head into the new year, we see a lot of reasons to be positive, but a lot of reasons to be cautious as well. We I think are on the eve of the synchronized global recovery, and it may be not as robust as some people expect it to, but I do think it'll be intact, and it will drive better overall economic growth across the globe. It'll help the asset markets, which include the equity markets. We're on the eve of better corporate earnings, and hopefully a potentially calmer U.S. political landscape. And then notwithstanding all that, obviously we've got the rollout of the vaccines. Even though the initial rollout's been a little clunky, we do feel like that will work its way out. There's a lot of calls to accelerate that. And obviously we've got other therapies which are in clinical trials right now, and probably will get some emergency use authorizations. So we'll have more net supply of vaccines on the market. And I think as we get into the second quarter, we won't have these choke points that we've got right now. But having said all that, I think the issue that we're facing right now, at least in the equity markets, is that a lot of these positive things have already been priced into the market. And I think it just bears a little bit of, maybe a little bit of caution here. We've seen a lot of movement and a lot of in a relatively short period of time. And I do think as I said, the economic recovery is kind of still in its early stages, but overall the capital markets are much, much farther along in this cycle. And compared with prior downturns that took tens of months to recover, we had a very dramatic recovery last year in just a small handful of months, very, very short time frame. Stocks and other assets, risky assets, could be vulnerable if we don't have as much growth that's priced into the markets right now. I mean, there's a certain expectation, and if it doesn't pan out, then that would be unfulfilled expectations. It would penalize the equity markets. But if growth is stronger than we expect, that could really create some upward pressure on interest rates and inflation, which could hurt valuations down the road. So, there's just enough reason to be cautious here as we head into the new year. But let's talk about what's going on here in the market over the last week. So. Last week, the Dow was up 1.6%, the S&P was up 1.8%, the NASDAQ was up 2.4%, and the Russell was up 5.9%, just the last week alone. And everything but the Russell, ironically, closed at a record. interestingly enough, that we had a somewhat weak jobs report, and we kind of expected this. There's some seasonal, gyrations here. Hospitality, leisure lost some jobs as we had some increase in restrictions because of the pandemic. We lost 140,000 jobs in December, and that's the first decline that we've seen since April. I do think that that's probably apt to reverse itself as we head into the spring, but nevertheless, it was something that served as kind of negative news in the market. And aside from the riots and as I mentioned earlier, the results of the Senate runoff elections, the interesting thing is that we've got we've got reasons why the market is going strong. Obviously, the riots aren't going to impact the economy. And I do think that the Democratic control or the lack of a split government, it's not a strong mandate. It's essentially in the Senate, it's now a tiebreaker situation with Vice President-elect Kamala Harris having the tie-breaking vote. And also, as I said, I think these job losses are somewhat temporary, and I think the market's kind of looking past this. And there's there's other things that we should be aware of too. We've had a lot of retail trading, and these are folks like you and me jumping in, getting a Robinhood trading account, or even getting a Schwab account and trading. We've got a lot of individuals playing the market. We've got high valuations. The market's at almost 23 times forward earnings, despite the fact that I do feel that some of that is okay because we've got very, very low interest rates. Sentiment is getting really extreme. There's the various indicators out there suggest that we're getting to extreme bullishness, which it seems to always set the stage for a correction. And we're seeing a little bit of a bump in volatility, which is something that maybe we pay attention to here. But we've got earnings season coming up. That starts this coming week. I should say, the pundits, if you will, which at one point I was one of those that contributed estimates. But the expectations are for a 12% drop in earnings, and this is maybe an improvement from the first and second quarter, and maybe a step back from the third quarter. But sales are expected to be down about 6%, but these are all fourth quarter earnings reports that we're expecting here over the next several weeks. But basically, I think the real read-through and the real important thing is not necessarily what's being reported, although it is important, but it's what management says about the future. And that's going to be very, very important in my humble opinion. But, as the market kind of looks past this in the equity markets, we've got, basically the power of all this money printing that we've been doing. We've got the odds of additional stimulus spending that are moving higher in the wake of these Senate elections, because that could increase, the likelihood that we're going to get like $2,000 stimulus checks for people below a certain income. And in addition, I think in a strange twist of irony, the payroll number, which showed that drop that I mentioned, could actually serve as a kind of a catalyst, if you will, an argument that more fiscal stimulus is needed because we've taken a step or two back, per se. And as I mentioned, we've got a lot of speculative trading. Interestingly enough, we're seeing an increase in margin debt and options trading, and I think a lot of people are kind of still throwing caution into the wind, when I think now is a good time to be kind of taking stock of that. But as we look at the year-to-date, which is only a couple of days old, interestingly enough, crude prices, $52 a barrel. That's the highest since the pandemic began. And, we had some announcements from Saudi Arabia that they were going to cut an additional 1 million barrels per day of supply over the next couple of months. which will help the energy markets, which really took it on the chin last year, as kind of basically we've talked about all year. And then on the fixed income side, and I've got some other notes on the fixed income side, Treasury yields moved higher in the wake of the Georgia election runoff. And the 10-year U.S. Treasury yield exceeded 1% for the first time since March. And it was up 0.2% from just the last week alone. And Friday reached as high as basically 1.12%. And so, what this kind of tells you is a little bit, the market is beginning to anticipate a better environment, more normalized interest rates, and this inflation issue, which sits there on the periphery. It hasn't really reared its ugly head yet, but as I've talked about in recent weeks, and I certainly alluded to in the market outlook, that I do believe that that's going to be a theme that plays itself out here in 2021. But so the 10-year Treasury closed at 1.07 on Thursday, and then it was stayed above 1% on Friday. And we've had, let's see, a 4-day gain was actually pretty strong. The 30-year bond yield is up almost 0.25% since the start of the year. Now we're pushing about almost 1.9%. And that's really predicated on this thought that given the makeup of the government now, that we're going to have higher growth from stimulus spending, which will lead to higher inflation. So again, there's that inflation thing coming up again. And then mortgage rates, we talked about housing. Had some really good charts in the charts of the week package this week on housing. And the 30-year fixed mortgage rate was 2.65%. But I would say if you're on the cusp of buying a house, I would lock in, get your 45 or 60-day lock if you can get it, because I do think that those mortgage rates are going to go up. That is certainly a once in a long while opportunity there. And let's see, going down the list of things here, we've got, what else? In this last week, foreign stocks actually have acted better than U.S. stocks, ironically. So we've got the EFA, which is up 3.2%. We've got the MSCI World Stock Index up 2.4 almost. Emerging market stocks are up 5%. And then consequently, as I just mentioned, with interest rates moving higher, the bond indices are starting off the year in negative territory. The Barclays aggregate index is actually down almost 1%. So, this is this kind of traditional environment where you get strong equity performance. You tend to have a little bit weaker performance out of fixed income. And, with rates being so low, I've always said that, if you're not in a short-term orientation in your fixed income portfolio, you are exposing yourself to meaningful price risk, and that's why our portfolios are aligned very, very short-term right now. And emerging market bonds are actually performing well in addition to the emerging market equities. So I do think that the theme, these various themes that I've talked about in the outlook, it's worth mentioning just a couple of these to kind of reiterate what's already playing out a little bit, is that global stocks, I think, are a little bit more in favor. So, portfolio-wise, we're kind of generally rotating a little bit more to foreign stocks, including emerging markets. On the fixed income side, as I've already mentioned, really pushing that short-term barrier, because I think, the prospects of a follow-on recession, while they're not 0%, I mean, they're certainly pretty low. And so the bias is for stronger growth, recovery next year. And if that's the case, then there is going to be, especially if there's inflation on the margin or inflation expectations pick up, those rates are going to move higher. So you want to avoid price risk on your fixed income portfolio. And something else that was in the Wall Street last week that I thought was really good to remind everyone is stay the course, make logical tweaks as you go along, which is kind of how we think about it. But you don't, hit that rocker switch and say, all right, I'm out of the market. And because it's hard to know when to get back in. And market timers can be good in stretches, but not good over long stretches. And here's something that was that I found in the Wall Street Journal, and Sandy Leeds also mentioned it in the last weekend's package. But if an investor put in $10,000 into an S&P 500 index at the start of 1980, that 10,000 would have grown to 700,000 today. But if you missed the top 5 days, that 700,000 would have been 425,000. So just think of that. If you missed the top 5 days in the market, you would have sacrificed, not quite half of your overall gain in the market. That's profound. And if you missed the top 10 days, you would have had 300,000. So you would have sacrificed basically 4/7 of your return, and over essentially a 40-year period if you'd missed the top 10 days in the market. So what that really says is it pays to stay invested and try to be as unemotional about investing as you can. And I realize it's hard for some people, and it's hard for some practitioners too, but that is a compass that will always lead you back, just thinking about how much that opportunity cost is if you choose to get out of the market and not stay the course. And then I'm actually going to try to keep it a little bit shorter this week because I'm focusing on really the market less so than the economy. But I just hit a couple points and then we'll conclude for today. I've talked about the energy markets. Saudi Arabia's decision, I think, is going to lead us to a better commodity basket overall. And we still have negative real interest rates. So I think that's going to continue to drive the dollar a little bit lower. So I think that's going to help exporters. And it's going to perhaps drive more inflation, more imported inflation, because I think the consumer is going to pick up in 2021 because we've got more stimulus, we've got a vaccine rollout, which will lead to more confidence. And I think that's helpful in this eventual recovery. And that'll probably lead to jobs growth. And then it's all going to serve to increase personal income, which will also drive savings rates and spending over the first half and into the third quarter of 2021. So, that demand for consumption, especially with imported products from overseas with a weak dollar, could drive imported inflation and to help augment the price inflation I think we're going to see anyway. But near-term investor sentiment indicators maybe look a little bit extended. So if we were to have a 5% pullback, I wouldn't be at all surprised. I would just probably consider that to be maybe a little bit of a buying opportunity. We do have, I think, a rotation which is going to play out, and we talked about this in the outlook, that we're going to rotate more to cyclical stocks. And I think this is the year that we see value really take the bull by the horns and then drive more of an enthusiastic response. So look for cyclical sectors of the market, as well as small caps, which tend to do well in an emerging recovery, which is what I think we're going to be dealing with in 2021. So, and I talked about rising commodity prices. I mean, these are all kind of tailwinds. I've talked about non-U.S. stocks and emerging market equities. I think those are all going to be tailwinds as well. I think something that we can all look forward to is, increased job growth, less, maybe societal discord, perhaps, maybe a less divided and volatile political environment, which I think will psychologically be better for all of us, certainly will help the markets as well. But having said that, this new administration is going to come at us before too long with increased taxes. And so when we talk about taxes, I think we can expect it on higher income Americans. I think we can expect it on corporations. I don't think that we're going to retrace that tax rate back where it was, but I think we could be giving up perhaps a good chunk of that gain. Maybe corporate rates go from 21 to 28%, and that probably gets through, as well as the tax rate on the uber wealthy Americans. And I do think that we're going to get we're going to get some increased regulation, and I think there's going to be an interest in environmental controls as we kind of jump back into some of these environmental conversations, which President Trump has exited during his time in office. But I think we're going to be getting back into those. So look for more regulation. Look for more environmental controls, and some of those will impact parts of the industry, parts of the economy rather. But I don't think it's going to be enough to kind of forestall, I think, this positive environment on balance that we're going to see next year. And I think if we can put up with the risk of some increased near-term volatility in the market because of these stretched valuations, I think the other side is actually going to look very good. So with that, we will conclude Market Minutes for today. And I hope you've enjoyed this presentation, the first one of 2021. I hope this note finds everyone safe and sound and happy, and that you've enjoyed your holiday season and ready for the new year. I know we certainly are. And I wish you a wonderful week. Appreciate you joining us this week. If you have any questions or comments, please feel free to reach out to us at the information provided, and we will get back with you. Have a wonderful week, and we'll talk to you very soon.